The silent invasion of private equity. You didn't vote for them. You don't see their names on any building. But private equity firms own more of America than you think. The hospital that just overcharged you for a routine checkup? Private equity. The grocery store that raised prices overnight? Private equity. The once thriving local business that suddenly collapsed? Private equity. Private equity firms operate in the shadows, yet their influence is everywhere. They don't just buy companies. They reshape entire industries, extract billions in wealth, and leave behind a trail of bankrupt businesses, rising costs, and job losses. This isn't just another story about corporate greed. It's about how an obscure financial strategy, designed to maximize profits in the shortest time possible, has fundamentally reshaped the American economy in ways most people don't even realize. To understand how private equity consumed America, we need to go back to the 1980s, when corporate raiders were the villains of Wall Street. Back then, firms like KKR and Blackstone pioneered leveraged buyouts, a financial maneuver that allowed them to buy entire companies using mostly borrowed money. The goal was simple: take control, strip the company down, make it appear more profitable, and then sell it for a massive return. At first, these buyouts targeted large corporations, household names like RJR Nabisco and Hertz. But soon, private equity firms realized they didn't need to limit themselves to Fortune 500 companies. There was an even bigger opportunity hiding in plain sight: essential services and everyday businesses that people relied on. Over the last 2 decades, private equity firms have quietly taken over industries that most Americans interact with daily: healthcare, retail, housing, media, and even education. The way they do it follows a disturbingly simple formula. 1. Buy the company using borrowed money. Unlike normal acquisitions, where a buyer uses their own capital, private equity firms take on massive amounts of debt to purchase companies. 1. The catch? 1. That debt doesn't sit on their books. It gets dumped onto the company itself. 2. Cut costs to boost short-term profits. Once in control, private equity firms slash expenses in ways that often hurt workers and customers. 2. This could mean reducing employee wages, cutting jobs, eliminating essential services, or lowering product quality. 3. Extract cash through fees, dividends, and asset stripping. Before they even think about improving a business, private equity firms immediately look for ways to siphon out money. 3. They charge the company hefty management fees, force it to take on even more debt, and pay themselves dividends, all while telling the public they are making the company more efficient. 4. Sell the company or let it collapse. If the company manages to survive long enough, private equity firms will eventually sell it to another buyer at a profit. 4. But in many cases, the business is left so financially crippled that it goes bankrupt. 4. By the time this happens, the private equity firm has already made its money and moved on. This strategy has turned private equity into a trillion-dollar industry. But for the average American, the results have been disastrous. Take healthcare, for example. Many hospitals and nursing homes are now controlled by private equity, leading to higher prices, lower quality care, and more medical debt for patients. In retail, legendary brands like Toys R Us and Sears were profitable businesses until private equity firms acquired them, drained them of cash, and left them to collapse under unsustainable debt. In housing, private equity landlords are making it harder for Americans to buy homes, buying up entire neighborhoods and pushing rents higher than ever. The scary part? Most people don't even realize private equity is behind these changes. They just see prices going up, services getting worse, and companies they once trusted disappearing. This isn't a conspiracy theory. It's a financial strategy that has been unfolding in plain sight for decades. And in the next part, we'll dive deeper into the industries that have been completely transformed by private equity and what it means for you. The industries private equity took over and what it means for you. Private equity firms don't just buy companies. They reshape entire industries, forcing businesses to operate under extreme financial pressure while extracting as much cash as possible. In the process, they have altered the way Americans experience everything from healthcare to housing, often in ways that are invisible until it's too late. Their strategy isn't about innovation or long-term growth. It's about flipping businesses for profit. And some of the biggest victims of this strategy are industries that people depend on every day. Healthcare, the cost of putting profits over patients. Private equity firms discovered that healthcare is one of the most profitable sectors in America. It's a necessity. People can't opt out of medical care no matter how expensive it gets. Over the past 2 decades, private equity has aggressively bought hospitals, emergency care centers, nursing homes, and even ambulance services. Their method is simple: acquire a hospital or healthcare provider, cut staff, reduce services, and raise prices, all while loading the company with debt. The result? Patients pay more, receive lower quality care, and sometimes are left with no access to critical medical services at all. Studies have shown that hospitals owned by private equity firms are more likely to overcharge patients, more likely to experience medical errors, and more likely to shut down in financially struggling areas. Nursing homes in particular have seen a significant rise in mortality rates after being taken over by private equity. But the real problem isn't just that private equity is making healthcare more expensive. It's that these firms don't care about running hospitals long term. They only need to extract enough money before selling the company or letting it collapse. Retail: how private equity killed America's stores. If you've ever wondered why so many beloved retail brands have disappeared over the past 20 years, private equity is a big part of the answer. Toys R Us, Payless, Sears, J.Crew, these weren't businesses that failed because of bad management or competition alone. They were deliberately loaded with debt and drained of cash by private equity firms. Here's how it works. 1. A private equity firm buys a well-known retailer using mostly borrowed money. 2. Instead of using profits to invest in better stores, the firm forces the company to take on more loans to pay its owners huge dividends. 3. When the retailer can't handle the debt, it collapses. But by that point, the private equity firm has already made its money and moved on. When Toys R Us went bankrupt, 33,000 workers lost their jobs, but the private equity firms that owned it walked away with millions in fees. The same thing happened with shopping malls, which were once the heart of American consumer culture. Private equity firms bought up malls, bled them dry, and abandoned them when they were no longer profitable. That's why many cities are now filled with empty, decaying shopping centers, monuments to a financial strategy that prioritized quick cash over sustainable business. Housing: why your rent keeps going up. For decades, homeownership was one of the best ways for Americans to build wealth. But private equity firms saw an opportunity, buying up homes and turning them into rental properties. Today, firms like Blackstone and Invitation Homes own hundreds of thousands of houses across the country. They outbid regular buyers, buy up entire neighborhoods, and then raise rents far beyond what individual landlords would charge. The effects have been devastating. 1. Homeownership rates have declined because families can't compete with billion-dollar firms. 2. Rent prices have skyrocketed in many cities, as private equity landlords charge as much as possible while cutting maintenance costs. 3. Tenants struggle with evictions, poor housing conditions, and constant rent increases because private equity landlords see them as nothing more than revenue streams. This isn't just a business decision, it's an economic shift that is making it harder for middle-class families to build wealth. When private equity controls housing, regular people lose the ability to invest in their own future. Media: the destruction of local journalism. Private equity firms aren't just taking over businesses that sell products and services. They're taking over information itself. Over the past 2 decades, hedge funds and private equity firms have gutted the newspaper industry, buying up local newspapers and slashing their budgets. Local journalism plays a crucial role in democracy. It holds politicians accountable, exposes corruption, and provides communities with vital information. But private equity firms see newspapers as just another asset to strip down for profit. Instead of investing in journalism, they 1. Cut newsroom staff, leaving fewer reporters to cover important local issues. 2. Sell off newspaper buildings and real estate to generate quick cash. 3. Reduce investigative reporting and shift toward sensationalist, click-driven content. The result? Many cities and towns no longer have a functioning local newspaper. And when local journalism dies, it creates a vacuum that gets filled by misinformation, corporate PR, and partisan media. Education: when private equity profits from students. Even education hasn't been safe from private equity's influence. In recent years, private equity firms have bought up for-profit colleges, online education platforms, and even student loan servicers. Their strategy is the same. 1. Maximize tuition and student debt. 2. Cut faculty and services. 3. Extract profits while delivering as little value as possible. Many for-profit colleges have collapsed under financial mismanagement, leaving students with massive debt and worthless degrees. Others continue to aggressively market to low-income students, promising career opportunities that often don't materialize. Private equity's takeover of education has led to an explosion of student debt and a system where higher education is seen as a financial asset rather than a public good. The bigger picture, why this matters. Private equity doesn't just impact individual businesses, it fundamentally changes how industries operate. 1. In healthcare, it prioritizes profit over patient care. 2. In retail, it turns once thriving brands into empty shells. 3. In housing, it turns homes into investment portfolios. 4. In media, it replaces journalism with financial speculation. 5. In education, it traps students in cycles of debt. The common thread? Short-term profits over long-term sustainability. But here's the question: why is this allowed to continue? In the next part, we'll explore how private equity firms manipulate laws, avoid taxes, and influence politicians, and why stopping them is so difficult. The private equity playbook: how they keep winning. Private equity is not some underground conspiracy or a secret society controlling the world from the shadows. It is a well-established and completely legal financial strategy that operates within the rules of modern capitalism. The question isn't whether private equity firms are breaking the law. It's whether the rules of the system itself encourage behaviors that benefit investors at the expense of the broader economy. To understand why private equity has been so successful, we need to break down the mechanisms that allow these firms to thrive. It all comes down to debt, tax advantages, deregulation, and the power of financial markets. The power of leverage. Why debt is the key to everything. One of the fundamental strategies behind private equity is the leveraged buyout, LBO. In simple terms, private equity firms use borrowed money to buy businesses, and they make those businesses responsible for paying back the debt. Why does this matter? Because in finance, leverage multiplies returns. If you invest $100 of your own money and earn a 10% return, you make $10. But if you borrow $900 and invest $1,000, that same 10% return gives you $100, 10 times more profit. This is why private equity firms prefer debt-fueled acquisitions. The more they can buy with other people's money, the higher their potential returns. And since they don't personally take on the debt, the risk is pushed onto the companies they acquire. For businesses, this often leads to financial strain. Even if a company was profitable before the buyout, it suddenly has massive debt payments to deal with. This forces cost-cutting measures, which can mean layoffs, lower wages, reduced investments in growth, and even bankruptcy. But for private equity firms, none of this matters. They collect fees and dividends early in the process, meaning they make money whether the company succeeds or fails. Tax advantages. Why private equity pays less than you'd. Another reason private equity is so powerful is because of favorable tax treatment. In the US, there's a specific tax loophole called the carried interest provision, which allows private equity partners to pay lower tax rates on their earnings than regular workers. Instead of being taxed as regular income, which could be as high as 37%, private equity profits are taxed as capital gains, typically 15 to 20%. This might not sound like a big deal, but when you're managing billions of dollars, this difference in tax rates can mean millions in savings every year. Additionally, private equity firms take advantage of interest tax deductions. Since they rely heavily on borrowed money, the interest they pay on those loans can often be written off as a business expense. This means that not only do they use debt to acquire companies, but they also benefit from tax breaks for doing so. Deregulation. How the rules have changed in their favor. Private equity wasn't always this powerful. Over the past few decades, financial deregulation has given these firms more freedom to operate without oversight. A key moment came in the late 1970s and 1980s, when pension funds and other institutional investors were allowed to invest in private equity. This opened the floodgates for billions of dollars to pour into the industry. Since then, efforts to limit the power of private equity have largely failed. Politicians from both major parties receive campaign contributions from financial firms, making reform difficult. Even when regulations are proposed, like closing the carried interest loophole, there is often strong resistance from Wall Street. Without stricter regulations, private equity firms can continue using aggressive tactics without breaking any laws. Market pressure. Why even good companies get bought out. One of the most overlooked aspects of private equity's rise is that public companies often become easy targets. On the stock market, corporations are under constant pressure to maximize shareholder value. If a company is seen as underperforming, private equity firms can step in, buy a controlling stake, and either restructure it or take it private. Sometimes, even if a company doesn't want to sell, activist investors, large shareholders who push for major changes, can force them to accept a buyout. This is how private equity ends up taking over companies that were once independent and well-run. For public companies, the pressure to deliver short-term profits often makes them vulnerable to private equity takeovers. Does private equity create value? The debate. Not all private equity deals are destructive. In some cases, these firms improve businesses by bringing in better management, restructuring inefficient operations, and driving innovation. For example, some private equity-backed companies have successfully expanded into new markets, improved productivity, and created jobs. Critics often focus on the failures, but there are also many examples where private equity-led turnarounds have been beneficial. However, the core issue remains. Private equity's primary goal is not to build long-term sustainable businesses. It is to maximize returns for investors. When a private equity firm buys a company, its goal is not to hold it forever. It wants to extract as much value as possible and sell it within a few years. This short-term approach often conflicts with the long-term health of the business. Can anything be done? There are several proposals that economists and policymakers have suggested to rein in the excesses of private equity. 1. Close the carried interest loophole. Tax private equity earnings like ordinary income. 2. Limit excessive debt in buyouts. Prevent firms from loading companies with unsustainable debt. 3. Increase transparency. Require private equity firms to disclose more about their business practices. 4. Protect workers. Ensure that layoffs and wage cuts aren't the first response to financial difficulties. But implementing these changes is easier said than done. Private equity is deeply embedded in the financial system, and any major changes would face strong opposition from Wall Street. The reality, what this means for you, private equity is not going away. It is a permanent part of the modern economy, and its influence will only continue to grow. The key takeaway is this. 1. Private equity firms operate within the rules of capitalism, using debt, tax advantages, and market power to generate high returns. 2. Their focus on short-term profits can often harm workers, consumers, and communities, even if it benefits investors. 3. Governments have the power to regulate private equity, but so far, reforms have been minimal. For the average person, understanding how private equity works is crucial. It explains why hospital bills keep rising, why once thriving businesses suddenly collapse, and why housing is becoming less affordable. Private equity isn't an evil empire controlling the world. It's simply a financial strategy that thrives in a system designed to reward short-term profits. The real question is, should the rules of the system change? Or is this just how capitalism is supposed to work? If you found this video insightful, don't forget to like and subscribe to the channel for more deep dives into the world of finance, business, and economic trends. I'd love to hear your thoughts. Do you think private equity should be more regulated? Or is this just how capitalism works? Drop a comment below and let's get the discussion going. And if you want more videos like this, hit that notification bell so you don't miss the next one. Thanks for watching, and I'll see you in the next video.